Limited Q2FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Advait Badekar from Ernst & Young. Thank you, and over to you, sir.
Thank you, Del. Good evening and a warm welcome everyone to Q2 and H1 FY25 earnings call of Blue Jet Healthcare Limited. Please note, investor presentation and the financial results are available on the company website and the stock exchanges. Also, anything said on this call which reflects our outlook for the future or which could be construed as a forward-looking statement must be reviewed in conjunction with the risks that the company faces. The conference call is being recorded and the transcript along with the audio of the same will be made available on the website of the company as well as on the exchanges. Please also note that the audio of the conference call is the copyright material of Blue Jet Healthcare Limited and cannot be copied, rebroadcasted or attributed in press or media without specific and written consent of the company. From the management side, we have with us Mr. Shiven Arora, Managing Director, Mr. V.K. Singh, Chief Operating Officer, Mr. Ganesh Karupanan, Chief Financial Officer. Now I would request Mr. Shiven Arora, Managing Director of Blue Jet Healthcare Limited, to provide you with updates for the quarter and half-year ended 30th September 2024. Thank you, and over to you, sir.
Good evening, festive greetings, and thank you everyone for joining us today. I'm pleased to share that we remain a leading CDMO company focusing on export-regulated markets. Our esteemed customers include top players in the medtech and FMCG sectors, along with innovators in diverse therapeutic areas. For Q2 FY25, we achieved a turnover of 2,071 million rupees, marking a sequential increase of 28% and a 18% growth year-on-year. Our EBITDA stood at 695 million rupees and we reported a PAT of 587 million, our highest ever net profit for a quarter, representing 28% of our total revenues. This quarter, we proudly completed our first ever dividend payout of rupees 1 per share, amounting to 173.5 million rupees. We continue to maintain a debt-free status with healthy liquidity reflected by our cash and cash equivalents and our treasury investments totaling to 3,233 million rupees as on September 2024. Following up from the last quarter, we have successfully commissioned Plant 6 at Unit 2 in Ambernath, incurring a total cost of 900 million rupees. This facility adds 120 KL of additional capacity, which will cater to our customers in the PI and contrast media segments. Commercial production of our PI client in cardiovascular therapy commenced in mid-September. We anticipate reaching our optimal capacity utilization in Q3 and Q4. Additionally, we initiated validation for our contrast media intermediate for an NCE molecule and expect the facility to meet surging customer demand in the second half of FY25. The end API is showing exceptional performance, positioning us to fulfill long-term client needs. Looking ahead, Unit 3 capabilities are projected to go commercial in FY26. We aim to use this as an opportunity to produce a key raw material which is currently being imported. Our capital expenditure plan remains on track. Engagement with existing and new clients continue to be promising with strong forecasts across all three product categories. Specifically, PI or CDMO category demand remains robust, which our Plant 6 capacity will support effectively. For contrast media category, Q2 supplies were steady, and we expect the demand for customers to stabilize from Q4 25 onwards. Thank you. On this note, I would pass it on to Mr. VK to give more insights about the business.
Hi, good evening, everyone. Season's greetings and a happy somewhat 2081. For a CDMO business, there are clearly two growth enablers, manufacturing capacity and R&D. At Blue Jet, we continuously debottleneck and add new capacity to keep in step with the growth that we envision. Our capacities are often co-engineered and built to suit to support our go-to-market strategy for customers who are mostly innovator and CDMO companies. We also build capacity to complete backward integration, which is a stated goal for cost leadership and strategic independence. Our current capex cycle, as Shiven mentioned, is mostly in step with what we had indicated in the past and is also synchronized with the customer lock-ins and supply contracts. At Unit 2 Ambernath, we have added about 120 KL at a cost of about 90 crores. This capacity went on stream in the previous quarter, and commercial supplies commenced in the last quarter upon successful completion of validation batches. While this capacity is versatile, it's been specifically deployed for making the intermediate for the CDMO cardiovascular opportunity that we were pursuing with an innovator company. As indicated in the previous call, we are commissioning incremental capacity of about 80 KL in the same block, and as we speak, the validation batches for an advanced intermediate orientated towards the NCE in the MRI space are ongoing. We expect commercial supplies to commence from this capacity in Q3 onward. At Unit 2, we are also building a small volume plant which we envisage will be ready for commissioning in Q1 of FY26. This plant will be primarily used for proof of concept, regulatory filings, and supplies of small GMP validation quantities to innovators for the clinical developments and trials. With the small volume plant, we complete our stated objective of building robust kilogram to multi-ton capabilities. Moving to Unit 3 at Mahad, at this site, we are creating a build-to-suit capacity for backward integration for contrast media. The effluent treatment plant at this site is ready for trials, and other common infrastructure is also nearing completion. We believe that this new capacity will get commissioned, as we had indicated in the past, in Q1 FY26. With regard to R&D, which is our second growth enabler, we have in the last 12 months doubled our R&D hardware and strengthened our scientific talent pool. However, to keep in step with the growth that we envision and the surge that we are witnessing in the CDMO RFPs, the number of R&D labs and scientific talent pool shall be further augmented. Some new chemistry platforms like pyrophoric chemistry, iodination, enzymatic platform, and a platform which is dealing with amino acid derivatives have been very recently added. As far as sustainability is concerned, between our windmills and solar, we have built capability to generate about 70% of our energy from renewable sources. We are continuously striving to achieve high level of atom efficiency in our chemistries and endeavor to make our industrial processes and plants environmentally friendly. With this, I pass it on to my colleague Ganesh to take you through the financials in detail. Thank you.
Good evening, everybody. I hope you are able to hear me. Before we get into Q2 performance, I just wanted to recap our Q1 performance, which was majorly impacted by Red Sea issues, whereby we had a higher goods in transit. This resulted in a lower sales recognition, and our performance in Q1 was lower compared to its sequential quarter. During Q2, despite of having higher goods in transit, higher than Q1, we were able to record a profit after tax of 583 billion, highest ever quarterly profit reported. Our reported turnover of 2,070 million for Q2 FY25 is an increase of 28% on a sequential quarter basis and 15% on year-over-year basis. For the same quarter, We recorded a gross margin of 57%, higher by 2% sequentially, and we were able to sustain a similar margin on year-over-year basis. Our reported EBITDA at 685 million is an increase of 57% sequentially and 11% year-over-year. We ended the quarter with a profit after tax of 583 million, an increase of 54% sequentially and 22% on year-over-year basis. For the half year, we recorded a turnover of 3,711 million, an increase of 3% year-over-year basis. EBITDA reported for half year, first half is at 1,137 million. This is lower by 6.4% year-over-year basis, while profit after tax at 961 million is an increase of 4.5% year-over-year basis. Now, let me just take you through some of our key product segment. We will first start with contrast media. In the contrast media category, product category, Q2 we reported a growth of 76% on a sequential basis, while it has degrown by 11% year-over-year basis. The H1 we reported a turnover of 1,779 million, a degrowth of 31% compared to H1 of last year. In the previous call, we had highlighted lower offtake by a key customer for calendar year 24 and certain Red Sea issues impacting our goods in transit, thereby impacting our revenue recognition. In the pharmaceutical intermediate category, we were able to sustain Q1 performance in Q2 also. While if you look at the H1 of FY25, we reported a turnover of 1,198 million, a growth of 282% compared to H1 of FY24. The impact, as VK Singh mentioned, the commercialization of one of our key products in the cardiovascular therapy has started in September from the new capacity, that's Plant 6. And we believe this new capacity is expected to drive rapid growth for us in the second half of FY25. In the artificial sweetness space, our turnover is more or less similar to last year. In H1 of FY25, we reported a turnover of close to 60 crores, similar to last year. We are able to sustain our turnover this year despite of headwinds from imports. Now, some of our key balance sheet items. We reported a return on capital employed at 33% and an asset turn of 3.39%. The new capacity addition impact now we could actually see in the second half of FY25. Our working capital is at 140 days, down by 7 days compared to Q1. We generated a free cash flow before treasury investment of at 318 million. Our cash conversion, which is profit after tax as a percentage of cash generated, is at 0.76, means that we are able to actually convert 76% of our commitment to finish this quarter. The capex during this quarter is at around 45 crores. So with this, we will actually take your questions.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, good evening. Happy Diwali to all the three. I got a few questions. First, I will start on the contrast media. We have shown a remarkable improvement sequentially, but on a YOY basis, we are still 11% down. And if I remember in the previous call, you did mention that for the full year, we will be able to hold on to the volume of last year. Then it is fair to assume that in the next quarter, there could be a sharp jump in the volume to make for that flattish volume versus last year. Will that be a fair assumption on the contrast media side?
Sanjesh, there will be two parts.
Okay.
In the H2, we are going to have a better product mix. So we will actually one of the new products would get launched. We expect this in Q4. And we have got a strong order book on the NCE molecule also. So we should be in a position to improve our performance in H2.
Ganesh, when you say a new product and NCE, are they two different products are we speaking about or the same product?
It's the same product.
It's the same product, right? Okay.
Yeah.
Yes. So what we are telling is that there will be, when you say better product mix, what do you really mean by that?
Earlier, if you look at our H2, in addition to the couple of products what we have commercialized, we will have a basket of 5 to 6 products, including some of our old products which are actually getting traction. So in terms of volume, if you look at contrast media as a segment, we believe we should be in a position to actually come closer to our last year numbers.
We still hold that we will do, because of the new product launches and traction in the existing product, we will be able to close the same volume as last year of contrast media, despite first half being slightly softer. Another related question, Ganesh, there is a 42 crores increase in the stock in trade in the first half. This in a normal situation would have booked as a revenue?
Yeah, that's actually the raw material cost. This quarter also, the sales cutoff is almost close to 100 odd crores. So this sale will actually flow in Q3, predominantly the contrast media. So this is when you have this Incoterms delivery at place, we can recognize shipment only when it reaches the customer's place. So till then,
that's what I'm telling. So this 42 crore otherwise would have been revenue, right? Which because of the Red Sea issue delay, the delivery is not getting recognized as revenue, correct?
You are right.
In a normal course, would that be a revenue for us in the H1, correct?
We have already invoiced. It will be recognized in next quarter.
Fair. So the second question again on the contrast media side, and we were anticipating one product on the iodination side. Where are we in the process for that product?
Very encouraging discussions during the customer meets and the trade shows recently. As indicated on the last call, the validation is successfully completed. And
validation is completed.
We are expecting to scale up in Q4 this year.
So that supply also will start up in Q4. So we said NCE in Q4 and this one also in Q4, Shivan, right?
That's right.
Okay. But for NCE there is a proper PO, but for the iodinated product we still don't have a PO. We are through with the validation. Is that the right understanding?
That is absolutely the right understanding, and it's a matter of time when we communicate this properly in the next call.
That's fair. I got two last questions. One on the pharma intermediate side. You said that we have started production in the unit plant 6 in September, but revenue appears to be flattish. Is that the shipping has not happened and hence the production and revenue recognition there is a lag? Is that the way to look at it? And the second related question is that I think, Shivan, you mentioned in your opening remarks that by Q3, Q4, we expect to completely peak out the utilization. That means this 120 KL will reach a peak utilization and the revenue recognition in the 2 quarters?
Yes, that would be the aspiration. I think we are inching towards it. Month on month, we see improved efficiencies and better experience when it comes from a scale-up standpoint. So in the next 2 quarters, I think we should ramp up to our customers' expectations.
So basically, there is an order book for the full plant. It's just a process we have to complete. And once we start producing it at optimal level, we are good to bill. There is no problem with the demand side or the book side.
Absolutely. We have confirmed orders on this particular candidate.
Got it. And the last question is on the 2 other products in the pharma intermediate you were aspiring. One was for oncology, one was for Parkinson. Any update you want to share on those 2 products?
So the discussions with the customers are very encouraging. I think in the next call we will have a better feedback around these aspects.
Got it. Thanks, Shivan and Ganesh for answering all these questions.
Thanks for asking and testing for that.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Sudarshan Padmaban from JM Financial PMS. Please go ahead.
Yeah, hi. Thank you for taking my question. Sir, just taking, from the earlier participant on the contrast media side, if my understanding is correct, apart from the new product, the NCE, our existing client was also expected to expand the capacity. Which is also the reason why we had seen the first quarter and some of the earlier quarters, some kind of a shutdown where they were expanding the capacity, etc. Can you give some color with respect to, whether the expanded capacity is in place, when is it expected to, start supply?
I'm not in the right position to answer on behalf of my customer, but I feel the overall traction in the market is extremely positive. The usage of contrast media, and especially with these market leaders, is increasing. So overall, I feel that we are well poised for a positive future going forward.
Sure, sir. And on the pharma intermediate side, if you can give some color, because you have, talked a lot about, the scale up which is going to be visible from the existing products and also the pipeline. We understand that oncology product, Parkinson's product, which is, yet to hit the commercial in a visible way. The cardiovascular is, of course, going to be the good driver. But beyond this, if you can give some color with respect to the pipeline, you should not necessarily give a number as such, but how many molecules are in the phase 3, how many molecules are in phase 2, how do you expect the progression to happen in that way? If you can give some color with respect to the next 2 to 3 years.
So in this segment, As we mentioned on our last call also, we were tracking about 8 to 10 opportunities. Two of them are currently commercial, but the full scale, for them to evolve will perhaps Q4 will be the right time to speak about it. But we are tracking those opportunities, and after the conference that we had in Europe last month, I think we have some more very credible opportunities with very high conviction. So I think in all, we are looking at 12 to 15 very high conviction opportunities in the space that you spoke about.
Sure. So one final question before I join back the queue is, when I look at this cardiovascular molecule, I mean, it would be probably the, only non-statin, product to, reduce cholesterol. I mean, I understand that we have set up the plant and it is expected to ramp up. But, if you can give some color with respect to the next 2 to 3 years, I mean, are we, having enough land, enough, space for us to add additional units if it is required? Do we see potential of this product being substantially bigger than, what currently we are seeing in the next 6 months?
See, we have currently in our plant 6, we have put up huge capacity. So I think we have capacity to take care of, the current demand and any uptick in demand for the next couple of years. So we are in a very good space as far as this molecule is concerned. As far as the outlook for the product is concerned, I mean, I would encourage you to go to, a lot of data in public domain. I think the molecule is very well poised to be a blockbuster.
Yeah, sure. And one final, I mean, if I'm looking at the margins in this quarter, I mean, of course, the mix was very favorable on the gross margin side and operating leverage. I mean, from a longer-term perspective, I mean, what should we be looking at as a steady-state margin as the molecule kind of scales up? Some color if you can give.
So based on the current portfolio, I would believe the margins would be in a similar range, maybe plus or minus 2%. So this quarter, because of a higher goods in transit, normally the overhead gets capitalized, so the margin is marginally higher. So I would actually take it somewhere around 53 to 55%. That should be a reasonable estimate for the current product mix.
Sure. Thanks a lot. I'll join back with you.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Amish Kanani from. A reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Sanjay Jain from ICICI Securities. Please go ahead.
Thanks for taking my questions again. I got a couple of them. Sorry, I had this follow up. First, on the chemistries which you spoke, Vijay sir, on the enzymatic process and few other processes. I think enzymatic process is something which is becoming very popular in China. And they are significantly reducing the cost of some of the molecules. Are these in the exploratory stage? Are we developing any serious capabilities here? And have we got people who have experience in the R&D for this? So how are we looking at these new chemistries and what are we doing to scale them up?
Sanjay, our reason for looking at these chemistries, particularly this enzymatic chemistry, are two. One is that whenever there is a chemistry where there is chiral selection involved, then the enzymatic process is significantly more effective than a regular chemical synthesis process. And the way we see business move, the direction in which the RFPs and inquiries are going, there will be a lot of molecules in that chiral selection space where we believe that enzymatic chemistry is going to be better. The second thing is that, as you know, the type of business that we are in, sometimes the effluent is very high. And when we use enzymatic processes, then sometimes, the effluent in the enzymatic is significantly lower. I mean, the ratios could be as high as 1:50. So if we were generating 50 in the regular chemical process, in the enzymatic it becomes 1 liter or whatever per kg of output. So these are two reasons for which there is a propensity in our R&D to move towards the enzymatic processes. As far as capability is concerned, then we have built up that, we had that capability, we have further strengthened that capability. And if you would see the IP space, we have filed a couple of patents also on which are leaning on the enzymatic chemistry. So we are in a good space as far as that part is concerned.
That's very clear. But we don't have any product commercialized in the process till now, right?
Sorry, Sanjay, it was not clear. Would you just repeat your question?
I'm telling there is no commercialized product as of now in our portfolio which uses this process, right?
As of now, no. But maybe next year, yes.
Oh, so we are very close to commercializing is what we are doing.
We are close to commercializing, yes.
And will it be for a general product, import substitution, or again working as a CDMO?
Are you speaking about this particular chemistry?
Yes, this particular chemistry.
It will be both.
Okay, we are planning for more than one product.
Yes. I mean, this is just a platform that we have developed, and we will be evaluating, this opportunity in many places. Because one thing that I forgot to mention was that sometimes the enzymatic is far more cost effective also.
No, the cost effective is well taken because I think the costs have drastically reduced and you move to some of these processes, and that is what is disrupting a lot of pharma intermediate space.
Yeah.
One follow-up question on the cardiovascular side. There is some apprehension of the production of GLP-1.
Sanjay, you have to repeat because the line was bad. Voice was a little garbled.
Now, can you hear me now?
Yes.
Okay. So I was speaking on GLP-1. Okay. In context to our cardiovascular product.
Right.
Do you see in a medium term any risk because when public reduce their weight, it automatically reduces their cholesterol level. That means the requirement for these preventive cholesterol measures become less in demand. Do you see the GLP-1s having the indirect impact in the medium term on the demand for our cardiovascular product?
So I would say that, what you are saying is clearly one line of thinking today, because now we are not looking at cardiovascular and all that. We look at it as one, big picture, which is cardiometabolic. So to an extent, you are right. But then, the molecules in pharmaceutical, it is not common to see obsolescence. The second point is that the product that we are talking about is actually the first line of treatment. It is quite possible that these GLP-1s may not, for several indications, be the first line of treatments. Besides, most of these GLP-1s will be injectables. So I think, and then even if there is a GLP-1 which can be positioned head on with this molecule, I mean it's a category. So this molecule will be competing more with the statins, will be competing more with azetamide, which is a non-statin lipid lowering product. So I don't really see why anything should change from the projections that we are talking about. Besides, anything to gain traction. Right now, the type of GLP that you are speaking about that can go head-on with the product is not there on the market. Let us say in 2 years, something is in phase 3, it comes, then the outcome trials will be needed. So which means that we are at least, 4 years away. So I would say that for the molecule that we are speaking about, without taking any names, the generic competition will be more credible than, the competition from anything of the sort that you are mentioning. But you bring out a very, very valid point, and we completely appreciate that.
Great. Thanks for clarifying that. Those were my questions. Thanks again, Vijay sir, for all those questions. Best of luck.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Amish Kanani from Novice Investment Managers. Please go ahead.
Hi, sir. Congrats on a reasonable second quarter and a maiden dividend. Question is, if you can remind us of the capex that we have already done in the first half and the remaining capex that we are likely to do in the second half and next year. And a related question will be, given that we are seeing and the opportunities, are looking at any incremental capex beyond what is already budgeted? Hello?
Yeah, so I think we are on track for our capex plans. I think our initial guidance was on a base case 200 crores annually. But we are also exploring other options from a manufacturing footprint standpoint. So we maintain our guidance.
Okay. And sir, looking at the scale up in the revenue and planned scale up in the second half, what should we pencil in directionally as an EBITDA margin? We have kind of done 30% in the first half as blended, but second quarter was 33. Given that there is a scale up, any indication of what kind of EBITDA margin should we be looking at directionally, if not a precise number?
We will give guidance on the future now. You can actually look at our historical numbers now.
Mr. Amish, does that answer your question?
Yeah, thanks a lot.
Thank you. Thanks, Amish.
Thank you. The next question is from the line of Tane Kotari from AUM Capital Markets. Please go ahead.
Good evening, sir, and season's greetings from my side to the panel members. I have just 2 questions, and that is with the contrast media. There is an increase of 75% seen this quarter, and there were certain factors that there was transit delays resolution that contributed in the last quarter. So the revenue, how much of the component is due to transit delay, and how much was the jump due to some other factors in the contrast media?
This goods in transit is an ongoing topic. Okay. Normally we used to have 30-35 days of transit, but because of the Red Sea issues, now it has become 55-60 days. So you can almost say that our transit time has doubled after the war situation. So what we try to do is ensure that we are able to maintain transit stock at similar levels. But the last quarter was higher, and in fact this quarter it is much higher. So there's going to be so it all depends on customer offtake, and in terms of transit period, we consider somewhere around 55 to 60 days. So this all depends on the offtake from the customer, and this cannot be predicted in advance.
Okay, sir. So, does the company anticipate a normalization in the growth rate for this particular segment, including whatever issues with the transitors? what is the kind of growth rate we are expecting in the couple of years if the same situation persists?
See, like the transit is not actually, one should not really worry about the transit issues when you look at the long term, because you have an opening and a closing goods in transit, so generally it should iron out. So technically that to me is not a concern. What you should be actually looking at is more on the product launches and the opportunities what we have on each of these molecules.
Okay. And just last one question, that is regarding the margins with each segment, like product mix we know, like 55% from contrast media, sweetness around 16%. But what is the kind of margins each segment is can I have those data, sir?
Based on the current product mix, I had already mentioned that plus or minus couple of percentage, we should be able to maintain this margin for the current product mix.
Okay. The blended margin should be between 35 to 40% or 38% for the annual when we look at this.
No, we cannot give a guidance, but you can actually evaluate based on your historical performance.
Okay. Thank you. That's all from my side, sir.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Himanshu Dugar from Safe Gains Advisors. Please go ahead.
Hi, am I audible?
Yes, sir.
Yeah, thanks for the opportunity to ask questions. I want to understand a bit about the timing on this, the volume and revenue recording for the contrast media business, because I understand in the last quarter as well we had some kind of lag in that there was a delay and then something would have counted this quarter. And similarly, I think last year also there were some similar issues. Could you just help us understand how the accounting works?
It's driven by the Incoterms, like whatever contract we have, the contractual term, if it says the delivery at place, which means you cannot recognize a shipment till it reaches the customer destination. So this is the first part. And the transit time has actually significantly gone up subsequent to this war situation. So what used to be a 35-day timeline has now become 55 to 60 days. And so, if you're familiar with the commercial terms, when you say delivery at place, only when it reaches the customer destination, we can actually recognize it as sale. And most of the contrast media customers would like to have the delivery at place as their contractual terms of delivery.
Understood. So just as a follow-up, if you go back to the last quarter's comments on some amount, could you just broadly highlight what was the revenue impact which shifted from last quarter to this quarter?
It will be around 60 to 70 crores.
And when we think on a like-for-like basis versus the last year, that is FY24 second quarter, how is it like? Are we increase on the volume?
I don't have that info readily now because that's the last year number. I think what you should worry about is the sequential number.
Okay, understood. Just last question from my side was on the margins. I think in the previous year, a couple of times I commented that because of the decline in the volatility in the raw material prices also have significantly contributed in the overall margin volatility. In this quarter, how was it? Was again the raw material prices going up and hence that somewhat on a YOY basis I'm asking this question. Did it impact the margins or there are other factors at play?
Margin raw material prices for our key raw materials were more or less consistent. We didn't see any high volatility. The top 2-3 raw materials remained more or less stable.
So what would you call it? Attribute the margin decline to them?
No, on a year-on-year basis, the margins were same, 55%. And during this quarter, it went up by 2%. So currently it is at 57.
All right, got it. Yeah. Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Aditya Cheda from InCred Asset Management. Please go ahead.
Good evening, sir. Thank you for the opportunity. Can you help us understand the degrowth that we have seen in contrast media for H1 to break it down between volume and realization, and what are the factors that drive realization in this segment? That would be helpful. Thanks.
There is no significant price variance. It's purely volume variance. Okay, we have actually talked about the 2 reasons. One of our customer offtake during this year is lower than the previous year because of certain reasons which we had already highlighted in the earlier calls. The second impact is on the transit. So these 2 impacted. I think one should not really worry about the transit delays because it's just a delay of a quarter. What you ship this month gets actually recognized as turnover in the subsequent month. In terms of offtake from the key customer, we had already indicated FY20 calendar year 24 is going to be a little bit subdued. And we believe this the offtake from this customer next calendar year, we should actually get back to the old levels.
Got it, sir. And any comments on what drives the realization? Is it purely on product mix incrementally for us, or the realization is usually stable for you or volatile? If you can help us understand that in this contrast media.
In contrast media, technically, we have not seen any significant price erosion. Generally, whenever there is a volume discount, it is generally offset by rupee depreciation. So we have actually not seen any meaningful price erosion in contrast media. So you can actually attribute everything to volume variance.
Got it, sir. That's it from my end. Thanks.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. Participants who wish to ask a question may press star and 1. A reminder to all participants that you may press star and 1 to ask a question. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
I think we would like to thank all the participants and we will look forward to hearing from you in the next call. Thank you very much.
Thank you. On behalf of Blue Jet Healthcare Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.